Hey, it's March 7th, and today I just wanted to go over what happened in that crazy market yesterday on TLT. This was the single biggest move we've seen in the bond market since the Lehman collapse in 2008. This is just unprecedented what happened today. Rates just plunged as people talked about the race to 0% interest rates across the globe. This pandemic related to the coronavirus has caused just amplified fears across the financial markets. Now, with stocks dropping and people taking their money and dumping it into the safety of U.S. government bonds, this ETF that yields about 1.65% and pays out a monthly distribution looks like an attractive alternative at this point of fear. Now, rates are still yielding around 0.74 on the 10-year and 1.27 on the 30-year. And TLT is supposed to hold bonds that have a weighted average maturity greater than 20, and it's currently TLT has a weighted average maturity of 25 years with an effective duration of around 18. So very close to a 20-year. So we're looking at something that's going to be moving somewhere between a 10-year and a 30-year bond. So if we're talking about going to zero, based upon my calculations, we should see TLT, which has gone from a price of around 136 to 139 the 1st of January, currently is trading around 166. My projection is that if we go down to 0.2, just above zero, then we're looking at TLT at around 207, assuming some greater convexity as rates continue to go down. So that's just a rough gauge. I haven't gone in and done the full calculation, but I've just done a relative comparison of where rates were in January, which were 1% higher than where they are today, and I just assumed a little bit of convexity impact, which would amplify the move when we go from 1.2 to 0.2%. So that's still a pretty big move, still waiting to happen. So at 207, you could start looking at options for opportunities to trade, and obviously some people already are. So what I wanted to do today was just talk about what happened in the option market on Friday. We had a huge gap up in TLT, up about 8, settled about 8.25 points higher, 5.2% right here. Traded as high as almost 170. So this is what I'm showing you is what happened to the 180 strike in the TLT calls across different maturities. Right here, this tells you the date and how many days away. What I want you to notice here is that you can look at the volume. Very little traded in September and December. The biggest volume was actually found 41 days out in April. And we obviously had a lot of volume on Friday for the weekly options, which are no longer here. Those have been taken off on Friday evening. So what we're seeing here is only the activity that happened 1 week out and beyond. But look at what happened to the change in price, percent change in price based upon the maturity of the options. And what you see here is that the options that are closest had the largest moves. So the 6-day options were up 3,000%, the 180 strike. And then when you go out to the most active month, they were only up 750%. And if you were to go all the way out 2 years out, you saw price appreciate only 68%. And the idea here is if you pick options that are closer to expiry and you get an unexpected move, because they were so cheap to begin with, because the risk was lower that the strike price would be reached, and then you had this unexpected move, which people then try to extrapolate out what could happen next. They start to say, well, if you went up 8 points today, what happens if you go up 8 points tomorrow, or maybe 10 points tomorrow and 12 points a day after? So they start to worry about a parabolic move, and that starts to cause the options to be re-rated all the way across. So what's interesting here is as you go further out to give yourself more time to be right, the downside to that is you won't see the same type of returns on your investment. But having said that, if you're a typical investor who's used to breaking even on their investments over the long haul or making 5%, whether you're making 3,000% or 500%, you're still doing a lot better than you would in any other kind of investment. So I just wanted to share this with you, the trade-off between giving yourself more time and the returns you're going to get. To the right side here, what you see is the expected price move for the options in those different time frames. So the 53%, for example, here, or let's go to the first one at 58%. This is just an average of the implied vol of all the options that are 6 days away. And the implied move is another $10 move on the TLT in the next 1 week. So those are pretty big expectations for next week, and which means the options are getting more expensive. Now the 180 strike, the implied vol is 64%, so the implied vol is actually higher on the 180 strike than the average option for that month, which means that this 180 strike being $20 out of the money means that the fear is actually to the upside. The panic is the market moving a lot higher versus a lot lower. And so that's what you're seeing priced into the options. Now, if you didn't buy the options last week and they've gone up significantly, then now you got to be careful if you haven't already bought these in the market, because everything's gone up significantly. The premiums are a lot higher. So this is a time when you really should be taking profits or legging into some kind of a debit spread. If you go in now and try to buy an expensive call and hope to get returns like what we've seen here, it's very unlikely to happen now. The biggest move has already happened. But think about this though. If the price on the 180 is $1.88 and this thing moves $10 tomorrow, it could be 180 tomorrow. And if that happens, obviously this price is going to be a lot higher. So you're still going to be looking at significant returns, but you just need to be aware of when's a good time to be buying options. When do you have to worry about volatility impacting your returns? So that's it. So just to summarize, huge move in TLT, expectations that we're probably going to 200 on TLT if rates get down to close to 0 on the 10-year and the 30. And if we do, there's different options that you could buy at different expiries, but just be aware, the further you go out to give yourself more time, you may be comfortable with that, but just understand that you're not going to see the amplified returns on a percentage basis as you go further out. So there's your trade-off between the two. And then here, obviously, you can look and see the different prices you'll pay as you go further out. Good luck.